So if we think about too big to fail as a misallocation of resources, and we think about wanting to have metrics, what metric can you envision that would capture misallocation of resources? I'm thinking about building houses out in the desert that shouldn't have been built. I mean, how would you ex ante pick out what the misallocation of resources is?
Yeah, I think, so my vision is, I think, well aligned with what we're seeing in this workshop, which is really picking up on the measures of the subsidy as being so that means that people are able to borrow more cheaply as a result of that subsidy. And so just keeping track of that, if that subsidy goes to zero, and we don't have a misallocation of resources anymore being caused by that subsidy. So tracking the subsidy, I think, helps a lot in that dimension. It would be useful. I'm sympathetic to the thrust of your question, which is it'd be nice to have ways to take that price measure and map it into quantities in some way as well. But I think that is not the first line of attack that I'm worried about. I think just tracking the price measure alone is going to be very helpful and very useful for us.
So I think the use of measures can be very valuable, but I have heard discussions about the use of a too big to fail measure in trying to assess a capital charge. In essence, if you want to compare it to your labor market example, it would be like using labor market measures for a minimum wage calculation. So what do you see as the ideal use of such measures? Would it be in monitoring, reports? Where are those measures going to be ideally used?
Yeah, that's a good question. I mean, FOMC, of course, is, I'm sure you know, I mean, we use the unemployment metric to determine something about the stance of monetary policy. So if unemployment is, outlook for unemployment is too high, then that tells us something about how to adjust the stance of monetary policy so as to make better improvement, more progress towards our objectives. I see these metrics can be used in the same way, that if they remain persistently high, I think that should be telling us something about whether or not we have sufficient capital being put into charges being held against those institutions. It may tell us something about the nature of the resolution planning. So there's going to be different ways to, I'm not going to be telling you exactly how to exploit it, but that's also true with monetary policy. We have many tools and we can exploit a lot of them to try to make better progress. But if these metrics are staying high, that's telling you something about the insufficiency of your ability to deal with the problem. And that means you have to do something about that. And I think others have talked about there's sort of an ex ante way to deal with this issue, which is levying more capital, and the ex post way, which is to try to improve the credibility of the resolution planning. And I would see if these metrics remained high, then you'd have to be pulling one of those two levers to try to improve things.
What do you think we need to be doing that we're not to get to the point you're talking about?
So the only point I'm talking about right now is that I think that when we talk about how we're doing on the too big to fail problem, say as the Federal Reserve System, we should be reporting more fulsomely about trying to track that progress more quantitatively than we're doing. I think right now there is a tendency to be talking about the inputs into the problem, which is we've done this, we've done that, and we've done these other things. So that's more on we've improved the resolution planning, we have more capital in place. That's all true. But then the question is what does that translate into in terms of the actual subsidy itself? And I think the way to do that is not to rely on any one measure as being perfect, but rather to be relying on a host of measures and figuring out the right way to, that's an important problem, but there's a right way to do that using appropriate graphics and tabular reporting as a way to ready to communicate.
Thank you. Over the last 5 years, the central bank in the US and other central banks internationally have massively increased the quantity of support, liquidity support to their banking systems and the terms, and ease the terms on which that liquidity support is offered. Do you think that that constitutes any sort of implicit subsidy? And if so, do you foresee that subsidy remaining in steady state as we emerge from the crisis?
So that's a good question. And it's a good question. When I say that, it means I haven't really thought as deeply about it as it deserves. So when I talk about this, I'm tracking more whether we're seeing a subsidy that's coming from loss protection. So whether or not people who are lending to the bank perceive that they're somehow being advantaged by the perception of prospective loss protection. Liquidity support, I mean, the Federal Reserve is famous for never having lost a penny on any of its liquidity operations in terms of what we do at the discount window. That's because we take a lot of protections to make sure that happens. So I don't see those as really being the same as loss absorption. So I guess I wouldn't follow you into that, into thinking about those as being the same kind of support that I'm talking about. That answer is worth about as much as the time I talked through it, because I haven't thought more deeply about it than that.
Does it take
A couple more, yeah.
As I think Ron could probably tell you better than I, supervisors view bad loans as being made during good times, when presumably all of these measures would be showing relatively low subsidies. So how do we go about unwinding that bias in the measures, or should we be looking at other ways to do it?
So that's a great question. That's what I was trying to talk about at the end when I talked about robustness. I mean, so when these measures are low, there's two reasons why they could be low. It could be because people perceive the risks to the economy essentially as being low, or it could be because they perceive the risk of loss as being low, given that those risks, those macroeconomic shocks or the bad loans actually turn out to be bad. Right now, the measures we have do not separate effectively between those two components. I think it would be useful to have that. I think it's going to be very challenging, I will say up front. But I will say the following: if the ex-ante measure remains high, I think that's a sign that we have a problem. You're pointing to the fact that even if it gets low, we might still have a problem. I'm sympathetic to that. But you don't want to give up on looking at measures altogether just because when they're low, that tells you that we might still have a problem. I'm sympathetic to that point of view.
The flip side for too big to fail would be too small to save, right? And the element of, do you think that there's the negative connotation of too big to fail helps that investors are actually better off investing in these type of institutions if explicitly or implicitly they're going to receive some subsidy, or because we're going to have somewhat of a negative view of institutions that get defined as too big to fail, that you're going to see maybe some of a return to perhaps a smaller or more local banking model?
I mean, it's so to try to highlight one of the other messages I was trying to deliver. It's more too complicated to fail or too vital to fail is for the terminology. Will we end up getting to a banking system which has more of a disconnection, shall we say, between the vital functions that banks are doing and government protection? That we might see happen. I mean, that's almost the point of making those activities costly. That is, to try to ending that. If you have government protection that's wedded to a particular vital functions that a financial institution are doing, that gives an incentive to keep those vital functions within the boundaries of the bank. If you remove that subsidy, then there's you have much less of an incentive to keep that within those boundaries. Well, in terms of tracking the ultimate destination of the banking system in terms of distribution and concentration, I think there's lots of forces at work on that. I think this is probably only one of many kinds of forces: technology, other kinds of regulatory pressures. So I don't think this is really going to be telling us a lot on that dimension where we're going to end up in terms of the size distribution of firms in the banking sector. What I think it might tell us about, as I said, is the kind of activities that we see our banks doing, what's glued together, might change. because there's less of a subsidy to put the vital function within inside an entity that's receiving finance and proceed to have that government support. Thank you very much. Appreciate it.